Hi everybody and welcome to ACCR's webinar on our 2021 shareholder resolution with AGL. For those of you that I haven't met before, my name's Marija Petkovic. I joined ACCR in February this year and work closely with Dan in our local climate campaigns. Before I proceed any further, I'd just like to acknowledge that I'm dialing in from Ngunnawal and Ngambri country. I'd like to pay my respects to elders past, present and emerging, and also acknowledge that sovereignty was never ceded. Prior to hearing from our two speakers today, I'll just cover a little bit of housekeeping. So heads up that this webinar is being recorded to enable some parties who were not able to join to view at another time. So please bear that in mind. Secondly, we'll structure today so that both speakers will talk first, and then there'll be a combined opportunity for Q&A following their presentations. Please, though, don't hold back in adding questions as they are talking and as they come to mind. I'll facilitate that session once we've heard from Marija and Dan. So, yeah, we have two speakers today. Dan Gocher, our Director of Climate and Environment, will speak a little later on the resolution that we have filed and our rationale for that. But firstly, we'll hear from Marija Petkovic from Energy Synapse. We're very lucky to have Marija here today. She'll be talking about the state of the national electricity market and why coal generators in particular are in so much financial pain. So Marija is the founder and managing director of Energy Synapse. She's a leading expert in wholesale energy markets and has worked internationally, both in Australia, New Zealand and the United States. Her team provides modelling and advisory services to project developers, investors, retailers, government departments and large energy users. And Marija's commentary has been featured in ABC News, Sydney Morning Herald, Renew Economy and more. Marija is a chemical engineer and has a Bachelor of Commerce from the University of Sydney. Marija, thanks for being here. I'll throw to you now.
Thanks very much for having me, Harriet and Dan. I'll just start sharing some slides. Great. So as Harriet's alluded to, I'm going to be talking about today on what we see as the disappearing role for baseload coal in energy markets. But I promise that it's not all doom and gloom, perhaps for coal, but certainly for businesses who can manage this transition. This is a once in a lifetime opportunity. So just a little bit of background on us for those that might not have come across us before. So we're an independent modelling and advisory firm, and our specialty is really all about the wholesale energy and FCAS markets. So we do a lot of revenue modelling for clean energy projects, as well as strategic advisory services. And we've just recently launched a new software tool that benchmarks the performance of every large-scale wind, solar, battery and pumped hydro asset in Australia's national electricity market. And this is something that we're really excited about. For anyone who's investing in this sector, that's going to be a really important strategic tool going forward. So we'll start out with what's been really the story of the last decade, which is renewables squeezing out fossil fuels. So here you can see the main sources of generation in the grid over the past 10 years. And we've had, black coal is at the lowest level it's been since the carbon tax period. And we've got the AGL's black coal assets such as Bayswater, that's the lowest, it's had the lowest capacity factor in this financial year, 2021, of 62%. That's the lowest really that it's ever had. Liddell is also quite low at 42%. So it's seen a big impact on black coal there. Of course, for brown coal, the assets that are still in the market there, still generating at quite high capacity factors, because for brown coal, it's a question of you either generate at very high capacity factors or you exit the market. And we've seen that a little bit before this graph with Playford B in South Australia and then Northern in 2016 and of course Hazelwood 2017. And gas hasn't been unscathed in this transition either. It's at the lowest level, this financial year that it's ever been. So what makes renewables really good at pushing out other assets is that they have a zero marginal cost. And the way that the wholesale market works is that all the generators put their bids into the market, how much volume they're willing to supply and at what price. And then EMO will choose the generators that offer the lowest cost way to meet the needs in the market. And when you have things like wind and solar bidding in at zero, that pushes out the higher cost generation, which is what we've seen. And some really big milestones recently with renewables, for the first time. So when we say variable renewables, that's wind, it's large scale solar and rooftop solar. So all VRE for the first time ever in financial year 2018. It exceeded gas generation, and then in financial year 2020 for the first time exceeded brown coal. So if we look at, I guess what's important for coal assets is to consider what's their wholesale value in the energy market. And on the right-hand side, you'll see that we've normalized that. We're just focusing on AGL's assets here. We've normalized that to be per megawatt of capacity, just so you can easily compare these assets. And then on the left, you've got the wholesale energy price. So this period, if you can see my cursor there, of the last couple of years was, what we call the energy crisis, where we had completely unprecedented high pricing in the market, and all the generators, including coal, really made super profits, in this market. And I mean, this was clearly unsustainable. These very high, revenues, that was obviously not going to be sustained going forward. So now they've come down to, much more normal levels. And just one important thing to note in this chart, you can see a bit of a bump up in the revenues during the carbon tax period, but this is the wholesale value of the generation. So it doesn't include what the generators would have paid out in the carbon tax. So the net effect of that would have been lower. But you can see there that, it's not actually as much of a doom and gloom situation as some may portray. And I wanted to show this slide because what we're talking about here is not necessarily asking coal to exit tomorrow. It's over a longer period. So just noting that the revenues are more back in line with what's been expected historically, and kind of not being surprised that those crazy super profits haven't kept going. But just one thing I want to point out here, you can see that Liddell is the lowest on this revenue chart. And again, that's mainly driven by the very low capacity factors of that particular asset. So not too surprising to see that one exiting first. Now, when we think about, what might happen in the future, which is really what the bulk of this talks about, we don't actually have to think too hard about that, because we've got the perfect example of what an energy transition looks like in the state of South Australia. So this is South Australia just 15 years ago. It was coal and gas, and you had this baseload coal plus peaking gas paradigm. And where that comes from is the economic characteristics of these assets. So for coal, it has a high fixed cost, it has a low marginal cost, and it's relatively slow to start, and has a relatively low ramping range. And what that means is that the most economic way to run that kind of asset is as a flat base load. Whereas when you compare it to something like gas generation, it's the complete opposite of that. So it's a low fixed cost with much higher marginal costs. It's quicker to start and easier to ramp, and that makes it much more suitable to meet the peak portion of demand. Now, obviously, I've simplified this a little bit. There is a fair bit of variation within these categories. So, of course, black coal is actually significantly more flexible than brown coal. And we are seeing, most of the black coal assets in the national electricity market. I mean, they are very much trying to shape their generation as much as they can around the wholesale pricing rather than running flat. And then within the gas category, things like closed cycle gas turbines, they tend to run a bit flatter, and they tend to meet what's called the intermediate demand here, just in between baseload coal and peaking gas, and then some of the open cycle turbines and the really kind of new technologies around rapid start, they tend to, meet these very high demand periods and high price periods in the market. But my point about this particular slide is that sometimes there's a misconception that in order to keep the grid stable, we need baseload generation. But the thing is, what the grid actually needs is that you need at any point in time, the supply for electricity and the demand for electricity must be in an exact balance. And the way you do that is very much an open question. Where baseload and peak come from, these are economic models based on the characteristics of these technologies. And it's the business model of baseload generation that is in danger by the energy transition. So this is South Australia now. So I've taken just a 15-day period, first 15 days, I believe, of April of this year. Now, the left-hand side of the chart shows you the total demand in the South Australian markets. I mean, nothing really too unusual there. But when you take away from that total demand, when you take away rooftop solar, and then you take away large-scale solar, and then you take away wind, the residual demand that you're left with is what's on the right-hand side of the screen. And as you can see there is no base load pattern there. This is not a pattern that coal is able to follow. So in the South Australian market, this is currently being met predominantly by gas, but it can be met by batteries, it can be met by hydro, demand response, and the future will likely use a portfolio of all of those technologies. But coal isn't able to follow what you see on that right-hand side. And that's what is the disappearing role of baseload coal in the system. It doesn't have a role in a highly renewable grid. And that's the really big challenge for anyone who has a high degree of coal assets in their portfolio. So the key question, I guess, is, how far away are we from, this South Australian reality being the reality for the rest of the NEM. And I'll just show you here all the projects that are currently under development. So this is just large-scale projects. It doesn't include rooftop solar, which just keeps breaking records year on year. But if we look at projects that are already committed, so I mean projects that have a very high probability of going forward, there's about 6 gigawatts of those. So that would be an increase of 26% on the existing capacity in the market. There's about 2 gigawatts of projects that are in a mid-stage development, and then over 110 gigawatts of clean energy projects that are in the early stages of development. Now, those early stage projects, I mean, most of them will not go ahead. There'll be issues around the feasibility, whether it's transmission or other issues, but just the fact that there's over 110 gigawatts of projects as of July of this year that are already being investigated, I think kind of illustrates just how quickly this transition is moving. It's not something that's going to take 20, 30 years. We are in the transition decade now. Now, we've done a fair bit of work around looking at the viability of coal. I can't share a lot of it because it was privately commissioned, but the key finding from that work was that coal generators are really going to struggle beyond 2030. And again, this was my point. We're not necessarily saying or kind of suggesting that coal is already uneconomical and should close straight away. But certainly if there's any coal left in the 2030s, those assets are really going to struggle to remain economically viable in the absence of some sort of government support. Now, there's been a lot of talk recently about the capacity mechanism that the Energy Security Board has proposed in late August to energy ministers. And, as soon as people saw a capacity mechanism, their first thought was, well, this is going to be potentially a bailout for coal. And there's two main factors that I want this audience today to be aware of. And the first one is that at the moment, this capacity mechanism is really no more than a thought bubble. So the Energy Security Board has asked ministers for in-principle support for a capacity mechanism. And if they're given that in-principle support, they will then go away for the next 18 months and actually develop the design for the mechanism. And then, and even in that process, it's quite possible that even if it did have this initial, in-principle support, this mechanism could fall over during that design stage. It's going to have to go through quite a robust stakeholder consultation process. And that's been, a lot of organisations have already voiced their concerns about this mechanism. So that's going to be quite a big hurdle to get over. And then even if it gets over all those hurdles, you've still got to give market participants enough notice before you put in a major market reform like that. So, our view is that you're unlikely to actually, even if everything goes ahead, you're unlikely to see this kind of mechanism in place really before 2025. So that's still a long way away. So that first point I wanted to raise was the timing. But then the second point is, as I've alluded to earlier, most people's first thoughts when they heard this was going to be the kind of golden goose for coal and the bailout for coal. But it may not actually work out that way. As I've said, the state of the mechanism at the moment is very vague. There's really no substantial detail around it, but the Energy Security Board has hinted at some of their thinking, and some of the documents they provided, they've actually indicated that they're looking at providing higher payments to assets that are faster responding and more flexible. So, this mechanism, depending on how it's designed, it could actually be a disadvantage to coal-fired assets. And then the other issue there, and I'll just flag, this hasn't been raised explicitly by the ESB, but it would be extremely easy, whilst this mechanism is being designed, to add some sort of emissions intensity threshold. And it doesn't have to be particularly low. If you set it at about 0.85, which is actually extraordinarily high, that would exclude all of AGL's coal generation fleet. So, there's a lot of uncertainty around how this mechanism would work, and it's certainly not necessarily the saving grace for coal. So for anyone who does have these assets in their portfolio, I wouldn't be, I wouldn't be relying on this mechanism to save you, because A, it might not go ahead, and if it does, it might actually disadvantage coal. It's not necessarily guaranteed to, advantage coal over other assets. So just to recap, I guess, on some of the key points that we see around the future of coal. So the first one is that the rapid growth in renewables, it's making the baseload business model obsolete. What's going to be valuable in the future is flexibility. Things like wind and solar, they'll give you access to low-cost generation, but what's going to be most valuable is assets that can, on demand, flex up and down, turn on and off very quickly. And as I've mentioned, that's gas, hydro, batteries, demand response, not coal. The other issue I want to raise here, because everything I've talked about so far has been the dynamics in the wholesale market. And some people might think, well, that's okay. We can just, get contracts in financial markets and the like, and everything will work out. But industrial energy users, who are the typical off-takers for, coal-fired power, they are moving towards renewable supply because A, it allows them to reduce their own costs, and B, it lets them manage their own carbon risks. And a really good example of that was Tomago Aluminium lately. They've announced they're the single biggest energy user on the grid. They're an AGL customer, and they've announced that when their contract with AGL expires towards the end of this decade, they'd like to be predominantly renewable supplied. So that, that combination of the wholesale factors and then also, energy users changing their preferences for who they want to contract with really means that coal will struggle to remain economically viable beyond 2030 without assuming that there's no government support. And again, just wanting to reiterate that that capacity mechanism that's being proposed, firstly, it may not go ahead, and even if it does, it could be a double-edged sword for coal. So it's not, something that should be relied on. And what really all of this means is that coal is now the highest risk asset that you can have in an electricity portfolio. And businesses who have a heavy exposure to coal really need to put a transition plan in place. And this plan shouldn't be over a period of 15, 20, 25 years. It needs to be a plan within this decade. So that's most of the things that I wanted to go through, but I look forward to all your questions at the end.
Thank you very much, Marija. That was very insightful. For those who joined a little later after our intro, we are going to be doing Q&A following Dan's presentation now. If you have any burning questions for Marija and don't want to forget them, please just type them into the Q&A now, and I'll facilitate that discussion in about 10 minutes. So now introduce Dan Gocher, our Director of Climate and Environment here at ACCR, and he's going to talk to our actual resolution and our rationale for that with AGL.
Thanks, Harriet, and thanks, Marija, for joining us today. I'm just going to share my screen. Okay, so this is the text of the resolution that we filed to AGL. It is very similar wording to the resolutions we filed to Santos and Woodside in 2020, which were both supported by more than 40% of shareholders. The only difference being that it refers to the demerger in the preamble. And we're not asking the company to set targets or to disclose targets in the demerger scheme documents, but alongside the publication of those documents. And we have asked the company to set targets for both of the demerged companies, so both ACCR and AGL Australia. So this is just to provide the context, and I guess this is the share price performance of AGL compared to the ASX 200 over the last several years. It's not the total shareholder return, it is just the share price return. So the total shareholder return, I think it's down about 30% compared to the about 70 or 80% in the ASX 200, but a similar divergence. And that's really being driven by that influx of renewables into the grid that Marija talked about. So just to refresh on what's happening with the demerger. So ACCR will take the large industrial customers, It'll retain 15 to 20% of AGL Australia, and and the core generation assets, so primarily the thermal generation. AGL Australia will take the business and retail customers, the trading capabilities, and most of the renewables, as well as the investments in the power fund, and Actu AGL in the ACT, as well as the gas peakers and batteries. So really that response generation. So in terms of the roadmap for the demerger, AGL has said that it expects to finalise the demerger by the end of this financial year, so 30th of June. So we have the AGM in a couple of weeks. We expect there to be an extraordinary general meeting on the demerger sometime around April, May, which would allow for it to be finalised by 30 June. And all things going to plan, the company will be listed before the end of the financial year. The risk here is that if that is delayed, then AGL may avoid an AGM in 2022. And we have seen that before with the Woolworths Endeavour Group demerger, where it took longer than expected, which is not unusual in these types of processes, given the negotiations around contracts and so on. And effectively Endeavour listed on 1st of July this year and will not be holding an AGM this year. So there is a risk that we won't see another AGM from the demerged companies until 2023. We are aware that AGL has said privately that there will be AGMs next year, regardless of the state of the demerger, but that is not a public commitment at this point. So this is what AGL has committed to date. So that first commitment there to publish a detailed climate change roadmap, including decarbonisation targets, was included in the 30th of June presentation, where the company provided more detail on the demerger. The second commitment there is on AGL's website, that it will provide the roadmap or the strategies for each of the demerged businesses in the demerger scheme documents. And again, I will reiterate that we haven't asked for the targets to be in the demerger scheme documents, but disclosed alongside the demerger scheme documents. In the 30th of June presentation, AGL confirmed that ACCR, which will hold the thermal generation, its emissions trajectory has those targets implied by the coal closure date. So 23% by 2024 is associated with the closure of Liddell, the 60% by 2036 with the closure of Bayswater, and 100% by 2050 with Loy Yang in 2048. Now, that is a trajectory that is based on the scenario A of the scenario analysis AGL published last year, and that equates to RCP 7, which is 3 to 4.5 degrees of warming. Now that is on the public record. That is not an ACCR conclusion. That is in AGL's disclosures. In terms of AGL Australia, it will list as a carbon neutral company for its operational emissions, but it will have a significant scope 3 problem in that it'll be sourcing most of its electricity from ACCR for the short to medium term. In response to the resolution, AGL committed to providing shareholders with a say on climate. So a vote on its climate transition plan at the first AGM for both companies. And while that's a welcome commitment, it doesn't guarantee that that plan will be Paris aligned. In short, AGL has said that it will disclose targets. It's disclosed the timeline that it'll deliver them. But what it hasn't done is committed to ensuring that those targets are Paris aligned. So this is a chart of AGL's capital expenditure since 2012. So it acquired Loy Yang in 2012, Macquarie Generation in 2014. And as you would expect, the amount of capital expenditure driven towards sustaining, so essentially maintaining the coal-fired power stations has steadily increased over the last 10 years. And significantly, the capital expenditure towards renewable generation, which is primarily the yellow bar, has significantly declined over the 10-year period. And that's really borne out in AGL's generation portfolio. So if you look at the amount of generation from its portfolio over the last several years, the contribution from renewables has not really shifted all that much. It's only grown from roughly 9% to 12% last financial year. And you'll notice that last financial year, that increase was not really driven by a significantly larger amount of renewable generation, but a decline in generation from Liddell, which Marija alluded to earlier. As you can see there, the carbon intensity of the NEM, which is the yellow bar there, has significantly declined over the last several years from the penetration of renewable energy into the grid. Whereas AGL's carbon intensity has essentially flatlined, which is, that's essentially what the numbers show. A couple of comments here about reliability. So Kerry Schott, the chair of the Energy Security Board, explains this dilemma of companies that own these assets, that if you spend less on maintenance, then it's a risk that you become less reliable. And AGL has suffered from that over the last couple of years with significant outages, both at Loy Yang and Liddell, where individual units were offline for several months at a time. And that second comment there is from AEMO report last week, which said that the reliability of coal-fired power generation is at historically low levels. And that's expected to, particularly as coal-fired power stations age, reliability will decline. To summarise, these are the primary reasons why we think this resolution is supportable. Number one is that the demerger shouldn't mean delay. So there's been a lot of criticism around this plan from AGL, and the market response has not been favourable for the company. But we think it'll have a material impact on the future pathways for both companies if AGL is to set Paris-aligned targets, and not necessarily negative. I think the market response to the demerger since March, the share price is down another 50% or more, that the market expects AGL to respond to this transition. And if there is 2 years before another AGM, that's a hell of a long time in the electricity market. So there is an expectation from investors that AGL sets Paris-aligned targets. Existing targets are certainly not Paris-aligned. AGL has never claimed that they are. but AGL is Australia's largest emitter. So in order for Australia's response to climate change to be effective, we need our largest emitters like AGL to be taking action. As Marija discussed, the lower wholesale electricity prices will continue as further renewables come into the grid. As I mentioned previously, reliability continues to decline with age. And that's true of all of AGL's of the 3 coal-fired power stations. As Marija mentioned, again, Tomago Aluminium committed to go 100% renewable by 2029. So Tomago is currently contracted to AGL until 2028. So we would expect further industrial customers to make similar commitments in the years ahead. The idea of targets is different to the resolution that we put forward to the company last year, which was asking for the closure of coal-fired power stations aligned with the 1.5 degree scenario. And that resolution was supported by 20% of shareholders. The idea with targets is that it actually allows the company the flexibility to be less fixated on closure dates and allow for seasonal shutdowns. So essentially only operating coal-fired power stations at peak summer or winter months, for mothballing individual units, which AGL has already done at Torrens Island. AGL's response to the resolution, in the notice of meeting at least, was primarily to argue that these coal-fired power stations were needed for system stability, and I think Marija's kind of proven that isn't really true. But I think the other thing worth considering here is that if AGL is to bring forward the closure dates of those coal-fired power stations, that signalling will drive further investment into renewables to replace that capacity in the grid. And lastly, AGL has conceded privately that it doesn't see those coal-fired power stations operating to 2036 and 2048, but it also hasn't publicly committed to closing them earlier. So we think the resolution is very supportable. It's language that it's been supported at other companies, and we think AGL will be better placed for it, as well as shareholders. So with that, I'll wrap up and stop sharing, and maybe we can go to Q&A.
All right, so thus far, I've got a couple of questions for the panelists, but I do note that we have one question in the chat, so I'll address that first. Please, others, please add other questions you might have as we work through this first one. So this is addressed to Marija. It's from James Taylor. What is your opinion on AGL's proposed demerger strategy? Is it a sensible strategy, or could there be alternative strategies that they could pursue?
Yeah, so I think I have to preface my answer here by saying that we don't advise on company structure and the like. We are humble energy market advisors. So take my answer with a grain of salt. But when I first saw, this announcement, my initial thought was that this was a way to try to protect the rest of the business from the risks that coal brings. I'm sure AGL is aware that, their coal portfolio is the highest risk part of their business. And if they can separate that from other parts, that potentially insulates, the other parts of the business that have a brighter future, perhaps. I mean, is there a better way to do that? Or are there alternative ways to do that? Having a plan and a strategy around how you plan to exit coal and what are you going to replace that with to not only ensure that you can still provide the equivalent energy to the market, but that you can also provide all those system security services like inertia and the like that coal provides, and having a robust plan around that. I mean, that is an alternative to, the quite radical choice of demerging the company.
Thank you. If there's none other from the attendees, I can jump in while people keep their thinking hats on. Marija, you spoke about the market conditions for coal being, problematic, and that 2030 is kind of, without any major government intervention, 2030 is sort of a likely end date for the assets. What are the rules around coal generator retirements in terms of notice periods, and how could AEMO sort of ensure system security if there is a significant number of coal generator retirements out to 2030?
Yeah, sure. So, I mean, that's a great question because this was such a huge issue when Hazelwood came out of the market. From memory, that was about 6 months or so notice. And that was a really big shock, well, I mean, not necessarily a shock that it happened, but just when it came out with such short notice, the impacts on the market were quite significant. So then as a result of that, new rules came in that said you had to give at least 42 months notice, which is about 3.5 years. And that obviously gives then people a lot more lead time and certainly enough time to think about how you're going to replace that capacity. But I mean, your points are very right there that it's likely that we're going to see early closure announcements. They might be, and it's not necessarily going to be one at a time. There might be a couple exiting within a short period of time, and then if it's more than 3.5 years. Then that's not necessarily, that might not be long enough. So I think, this is where, organisations like AGL, they have the opportunity to really play that leadership role and, develop, start developing a plan now for the next 10 years and really know, as I said, how they're going to replace their exiting capacity while making sure that they're still providing those essential services. So it's certainly something that companies can, start thinking about now, external of EMO rules. I guess this is one of those issues as well that some of the ESB recommendations are trying to address and the like with their capacity mechanism. But something that hasn't been talked about too much lately, which I had a conversation with Dan about in our last chat, Dan, was some of the reverse auction schemes that were proposed several years ago, where you run an auction to, and then basically coal-fired generators say, this is what we need to be paid to close a plant by this date, and then the kind of cheapest cost options, they get chosen. So I mean, those kind of mechanisms, I think it's a shame that we haven't explored in a bit more detail.
Thank you. Another one for you, Marija, before I turn to Dan. And again, shout out to the audience. Please add your questions in the chat should you have any. So there is a lot of talk about sort of grid congestion and the need to build out the network to accommodate the connections of renewable energy projects to backfill the capacity that coal particularly is providing. And we're seeing that the Victorian and New South Wales governments are very attuned to that in their development of renewable energy zones. So with this in mind, what sort of competitive advantage does AGL have with the existing network connections that they hold for their coal generators? And what is the significance of that competitive advantage, and when should they sort of start planning to kind of capitalise on that advantage as well?
Yeah, so again, a really good opportunity that isn't discussed sometimes, because even if you say close a coal-fired power station down, all the grid infrastructure that's on that site, I mean, that has potentially a lot of value because, there's some, project developers that have spent several years, kind of testing the feasibility of various grid connection points and millions of dollars on grid connection studies and the like. So, I mean, if you've got that infrastructure in place, it could potentially let you hop over some of those hurdles and, save a fair bit of time and money. And again, I'm sure, I think AGL's already got some plans to potentially put batteries on some of the sites where their coal generators are currently. But again, I think progressing that from just being a thought bubble to actually, doing some of those studies would be the next logical step.
Thank you. Okay, Dan, one for you. So this resolution we're filing with AGL, but it will influence the decarbonisation planning of two separate entities, the demerged entities. What level of influence does AGL have over those strategies of the demerged entities? How effective might this resolution be?
Well, at the moment, AGL has complete control because those entities don't exist yet. As you'd see from the media reporting, AGL is starting to kind of split its staff to where they will go. So you've got current AGL executives moving between, notionally being responsible for either ACCR or AGL Australia. So Christine Corbett will be the new CEO. Obviously, Graham Hunt will remain the CEO of ACCR. And individual executives have been appointed to, Chief Financial Officer or Chief Operating Officer for each company. So at the moment, all of the people making decisions are still AGL staff. So that's that won't change until such time as the extraordinary general meeting and approves the demerger process. And really, what will happen in that demerger scheme documents, and I guess what from the information that the company has said that it will commit to publish over the next several months, is that those strategies for both of those companies will be notionally disclosed. So you'll have some idea what those companies' plans are before the demerger is actually settled. And the AGL has tried to argue that allow each of those companies to work out their own plans. And while that's true to an extent, and they can obviously do their own thing once they become a listed company, in order to vote on the demerger proposal, shareholders should be, understand what they're getting, right? So they should know, what each of those companies' plans are, particularly over the short term. And I think that's why it's really important for the company to be setting targets in the as quickly as they can.
And just to pull out a key point from your slides as well. So AGL is committed to providing shareholders a say on climate at the first AGMs of the two demerged entities. What are the risks, or what do you think the likelihood is of those first AGMs occurring in 2022 versus 2023?
Probably even money at this stage. Just looking back at some of the demergers that have happened in recent years, I gave the example of Woolies and Endeavour Group, or if you look at BHP and South 32, they typically go long. They typically take longer than what the companies expect them to. So there is a risk that there won't be an AGM next year. And even if the company commits to having an AGM, then it could almost be a non-event next year if they're kind of very close to securing or to finalising the demerger. So particularly how investors vote this AGM, could have a fairly significant impact on the company's trajectory over the next couple of years.
Okay, one more for you, Dan. So the transition task, particularly for ACCR, the entity that will hold the coal generation assets, will be quite significant. And you might say that board and leadership will really require significant climate competence to navigate that transition. What are your views on the needs for that board and the current sort of makeup in terms of meeting that need for climate competence?
Look, we're not the first to point out that the three directors that have been nominated to go on to the ACCR board, so that's Graham Hunt, the CEO, Peter Botten, the chair, and Diane Smith-Gander, have all been on the board for at least 5 years, maybe 4 years for Peter Botten, but probably more than 7 or 8 years for Graham Hunt and Diane Smith-Gander. So they've really, as board members for that period of time, they've overseen that decline in the share price. So you must be questioning their ability to make the hard decisions when it comes to the energy transition. So but the company will be looking for directors to fill both boards, both AGL Australia and ACCR, over the next 6 months. And the types of experience they would be looking for, you would hope they'd be looking for people with experience in renewable energy generation, but not necessarily. They might be looking for people with business transformation experience, and people who've operated in really dynamic sectors. So you could be looking at something like tech, for instance, or even medical industries, biomedical or something like that. So just thinking of other sectors where there is, constant change and dynamism, that appears to be one of the ingredients that's missing on the board at the moment, is that ability to make the rapid, decisions in a rapidly changing environment.
Thank you. I'm noticing that the Q&A line is not running hot, so I am just pursuing my own agenda here, which is fun for me. Yeah, we're sort of nearing 2 o'clock now, so I might just throw to Marija and just to get her sort of final sort of reflections on the state of the energy transition within the NEM. I mean, we've sort of known this is coming for some time. Ideally, it would have been a sort of smooth and planned affair. Perhaps it might be better described as kind of potentially messy or abrupt now, but yeah, keen to hear your views and how you would describe the state of the transition.
Yeah, I think you're right there that it's been more unplanned and chaotic than it perhaps needs to be. But I think even though we all know about the energy transition, the pace just keeps surprising a lot of people. Like especially when you think about things like rooftop solar and the uptake of other large-scale renewables. I mean, it just keeps exceeding all expectations, and perhaps our expectations are too low there. But we're now at a really interesting point when when renewables first started, the economics weren't there. But now already for several years, renewables are your lowest cost, your lowest cost generation. Battery storage is already, again, on paper, the business cases look difficult to prove, but then you've got batteries like Hornsdale that are returning their capital in 2 years, which is extraordinary, in reality. So, these assets are overperforming, particularly batteries, much more than their business cases. So we'll likely see, greater uptakes there as well. But I guess one of the things that I'd personally like to see is just in terms of the government policy or lack thereof from our federal politicians, it's created a lot of unnecessary risk in the market. And at the end of the day, consumers pay for that risk, and it results in a much more chaotic transition than it needs to be. So, I mean, even really the government stepping out of the way at this point would be better than the kind of quick random interventions that we've been seeing. I mean, ideally there'd be policy framework, but even if investors had the certainty that the federal government wouldn't intervene in the market, even that on its own would give a lot more certainty than what we have now. I mean, as I said, unfortunately, we're in a much more there's much more turmoil than there needs to be.
Thank you, Dan. Any other final comments or reflections or final pitch for the voting on our resolution?
Only that I'd add when we put up the resolution last year, one of the responses that the company put forward and some of its shareholders actually was that it was, and this is when wholesale electricity prices were much higher than they are now, was that it was uneconomic to close these coal-fired power stations early, and I think that argument has dissipated quite a lot in the 12 months since, because I think that decline in prices and as well as the AGL share prices, most people have now realised that they won't last that long, and that decision may be taken out of AGL's hands, which I think is an interesting change.
Definitely. Okay, well, thank you everybody for joining us today. For those of you who aren't aware, although the link to our investor briefing was included in the invite, wasn't it, Dan? So people should have access to that.
Yeah.
Do we intend on circulating any slides? Will we make these slides available? It may not be necessary on top of the briefing. Yeah. Okay. All right. Well, thank you, everybody. Reach out. You probably have Dan's contact details. Please reach out to ACCR if you have any further questions to clarify your sort of thinking on AGL. And a huge thank you to Marija Petkovic for joining us today. Your insights have been invaluable. Yeah, so fantastic to have a market expert communicate things so clearly and concisely. So thank you. Okay, well, we'll wrap up for the day. Thanks all.